You're listening to the Ag Policy Connection, brought to you by RealAgriculture in partnership with the Canadian Agri-Food Policy Institute. We're connecting the dots between the people and the policies that shape agriculture and farming today and into the future.
Over the years, they've been referred to as farm support programs, safety nets, income stabilization programs, business risk management. When it comes to the programs that governments offer to help farmers cope with the financial risks inherent to farming, the terminology, the abbreviations, the names, it's just one aspect of how these programs have evolved over the years. I'm Kelvin Hepner, and this new episode of the Ag Policy Connection, brought to you by the Canadian Agri-Food Policy Institute, or CAPI, and RealAgriculture, is focusing on business risk management, or BRM, as we know it today, the evolution, the how, and the why we got where we are today with AgriStability, AgriInsurance or crop insurance, and AgriInvest being the big three programs across the country. What these programs might look like in the future, as we're not only talking about weather disasters and market volatility, the stuff that we see at the farm level, but international trade agreements, federal provincial politics, financial literacy rates, carbon emissions and climate targets. All of these things are factoring into this conversation about business risk management and what it might look like going forward. Our panelists for this episode are Grace Skogstad, political scientist and professor at the University of Toronto, a distinguished fellow with the Canadian Agri-Food Policy Institute; Steve Funk, director of MNP's Agriculture Risk Management Resources; and Al Mussel, agriculture economist and research lead with the Canadian Agri-Food Policy Institute. All right, welcome to the Ag Policy Connection. Steve, Al, and Grace, thanks for joining us today.
You're welcome.
Yeah, thanks for having me.
Likewise.
Why don't we start with a bit of history? I think to understand what we have today in terms of business risk management programs and where we might be headed in the future, I think we do need to look back on how we got to this point. And maybe we'll start with you, Al, in terms of the 1980s, kind of where we go from there. I know we covered some of this territory in episode 1 of the Ag Policy Connection with Douglas Headley and Scott Ross, but I think we'd like to expand on it. Al, why don't you start with the context going back to the 1980s, where things were at in terms of risk management and income stabilization support programs for farmers?
Well, Kelvin, I think I would actually start with kind of the international context and how I think that plowed into our domestic programming. So first, when you go back to the 1980s, you have to remember it was a period of time in which we did not have the kind of nomenclature to describe products in international trade that we have today. There was another system, but it was very different than what we have today. So we didn't have a common nomenclature to describe the products. That had to be developed. It's now called the harmonized system. But the Canada-U.S. trade agreement was negotiated without the harmonized trade system, for example. So it was there was a bunch of difficulties there. Then secondly, we didn't have the architecture to describe support or protectionism in agriculture. So for example, we didn't have a definition of domestic support or subsidies, a rigorous definition that is. Didn't have the same definitions for export competition, so that's your export subsidy. And similarly, we didn't have the same precision around border measures, tariff equivalents, because you have to recall, at the time, many countries, including Canada, employed what was called a binding import quota. And I think it was really after we clarified, first had a way of defining the products at a fairly detailed level that were going to be traded in international trade. And then secondly, we had this rubric that spelled out what was meant by protectionism, that we could A, get an international agreement, but then B, in Canada, where, in effect, or at least in important ways, a national agricultural policy has to be built. It doesn't present itself because provinces have so much authority in agriculture that we could then set about saying, okay, now we know, as a trading nation, where we're going to be internationally. Now we can come together and have a more fulsome and robust national agricultural policy because we know where we sit in international trade.
Grace, is that how you would frame it as well, going back to the 80s?
Yeah, I think so. I mean, I would say that I agree with Al. I would, the big shift from the GATT to the WTO is usually described as the WTO, the World Trade Organization, and the Agreement on Agriculture that accompanies it in the what came into effect in 1995. The big shift there was to what people call inside the border measures, right? And so trade agreements had been basically looking at border measures as Al has pointed out, tariffs, that sort of thing. And then there was the realization that, that the government support measures for incomes, other things like that, were trade distorting. And so he's right that there was a very different sort of reconceptualization of what protectionism could look like. And basically the focus is around trying not to distort trade, right? And so it's this focus on trade distorting measures and a much more encompassing notion than had been hitherto. I guess the other thing I would add is I agree that there's also a shift to a national agriculture policy. I would see that shift coming a little bit earlier, with the government of Quebec being pretty aggressive in terms of bringing its own agricultural policy in the 1970s. You can take it back to there. Alberta kind of starting to move as well, because even though it was a shared jurisdiction, historically the provinces had not assumed the same sort of role in agriculture that the government of Canada had. If you think about the price stabilization programs, in dairy and in the grain sector, those were federal programs; they weren't provincial programs. So you can see this sort of resurgence of provincial authority in agriculture is a little bit earlier, but certainly it does pick up steam, from the 1980s onward. And then you get into the situation where provinces have their own programs that are benefiting their own producers at the expense of producers elsewhere, and then that sort of gives huge incentives then to try to work in more cooperatively and more harmoniously to kind of get a level playing field across the country.
Is that when things started to shift more towards a whole farm margin-based type program as well?
Yes, well, there's two things going on here again, because the OECD and does not like commodity price supports, right? And they are seen to be particularly inducive to production, particularly trade distorting. And so the concept of a whole farm income support is seen to be much less trade distorting, right? But it's also, there are financial considerations that are behind this as well. But it is about sort of creating much more of a level playing field if you think about the whole farm income, rather than stabilizing and trying to raise the price of particular commodities, because as we know across the country, provinces vary in terms of the significance of various commodities.
I want to give Steve a chance to talk here too, but just to build on that, I think there's two kind of important points here with regard to the whole farm programming. First of all, as this evolved through the 1970s, 1980s, and the 1990s, and I think in the previous episode, Douglas Headley made reference to this, the pressure built to provide equity, for equity of access to federal funds through agricultural programming, and that ends up building a lot of the impetus for the whole farm programming. That was important. I think the second thing that was important was we went through the experience of the hog countervail cases in the 1980s and 1990s, and it absolutely, it petrified elements of the industry to have to, the prospect of having to go through that again. I mean, you remember that the Alberta cattle industry was concerned enough about this that they wanted part of NISA at one point. So the awareness that if we had commodity-specific programs as an exporting country, we were liable to be subject to countervail in particular associated with programming, I think really galvanized the idea that we have to find a way to do this differently, and that took us to whole farm programming.
Al, you just mentioned NISA. I know some of our audience will be familiar with NISA and GRIP and some of those programs. Some of our audience will have also just heard those abbreviations and not be super familiar with those programs, and I'm probably in that camp. Steve, what do you recall from some of those programs, those initiatives, and can you maybe fill us in on on what they did, how they worked for producers?
My experience in this whole world starts in 1995 when I moved to Alberta, and immediately started working with what was a 2-year pilot project in the Farm Income Stabilization Program, which later was renamed to the Farm Income Disaster Program. So that was the first whole farm margin-based insurance. But at the time, NISA was still operating, and NISA was a savings account for producers. They could contribute a certain amount of their eligible net sales, a certain percentage of it each year, and have that matched by the government. And at the time, there was bonus interest on the contributions that went into there as well.
To my recollection is NISA would have come in the early 1990s, if I recall.
Yeah.
And just to take it up to the current time period, when AgriInvest came in, some of us had been around for a while. We kind of called it, so this is the new NISA. I mean, the programs have a lot of similarities. Now, one of the elements that is not a similarity was the interest subsidy that we had in NISA.
Okay.
Yeah, the National Income Stabilization Account, NISA, was in the 1991 Farm Income Protection Act, and that also had the GRIP, that Gross Revenue Income Program, and it had crop insurance. They rolled those three into that 1991 set of programs. Okay.
So when we get to the early 2000s, then with the Ag Policy Framework and the launch of AgriStability, AgriInvest, the insurance suite, kind of much the framework that is still in place today. How big a change was that at that time in terms of business risk management programs for producers across the country?
Yeah, well, I think a couple of things here is that I would emphasize how these programs evolved. I mean, this is a sort of, as you can tell by the way that the titles of them change, that this is an evolutionary process of change, that, you get some programs in, you get feedback on those programs, the problems with them, there's a new configuration of them. But, so from about 2003 onward, I mean, the first federal provincial framework agreement is 2000 to 2003. And then after that, after 2003, you start to get 5-year agreements, right? Which is what the era that we're currently in. And the actual, sort of core of those agreements around business risk management, in my view, doesn't change a whole lot. But they get named new things, but also what you see happening is adding on these strategic initiatives that federal government's got some of them that it's funding, and then you've got some that are cost shared. And so you get, I think, a kind of a bit more elaborate set of programs here. The business risk management ones that include the farm support, those still remain a large core of them and take up a significant amount of funding. But there is, I think, a kind of a broader notion here, if you like, of what all is entailed in agricultural policy. So, you get programs for food safety, you get programs for science and innovation. So there's a kind of, to me, this means that the idea that agriculture needs support remains a very, integral idea, but there are new rationales, if you will, introduced for government support for agriculture, the agricultural sector, agriculture and agri-food sector, kind of a more expansive notion of all of the kind of functions and all of the different sort of instruments that are needed here in this sector to help it be competitive and to thrive and to adjust constantly to a changing context, because I do think the international context is changing, the domestic context is changing. And so that's how I see this kind of trajectory of programs over time, that they are reconfigurations, but they are not, in many ways, I would say, sort of radical shifts from the past. It's a kind of cumulative process of change.
I guess what I could add to that, Calvin, I guess sort of two things. Prior to these 5-year agreements, what we were doing was we were as a sector, especially at the federal level, you're going back to the cabinet and you're asking for money to fund these, these streams of programs. And what I think Doug Headley told us in the previous episode was that it was easier for government to throw money at the problem than to really address the issues of the sector through programming. And what the APF gave us was a window of 5-year fixed programming, and I think that was really important to set about dealing with some of the issues of the sector. Not going to suggest that we solved them, because as Grace just said, they keep evolving. But I think that was actually a pretty major accomplishment. The other thing that resulted from that, I think, was you go back to the difficulties that we had with NISA. So I guess a little bit of history. Some of your listeners will remember that one of the issues with NISA that ended up developing is because there's an interest subsidy in it. People tended to leave NISA deposits and the match in their accounts, and they just built up. They weren't, in fact, being used as a rainy day fund for the most part, at least. The balances built up and built up and built up. Well, we reached a point, and Grace can correct me when exactly this was. It would have been probably in the early 2000s, and it was a time when Lyle Van Cleef was the minister. And it was not a happy time in Canadian agriculture from an income level and stability perspective. And you had these two MPs, and if I recall, Grace, I think it was Bob Speller and Ralph Ferguson. What they did, they went across the country and they had these kitchen table meetings and so on. And they came back, and I think what they said, if I want to make sure I have my numbers right here, so just take it with a grain of salt, but I think it was $600 million. I think they said the sector immediately needs an ad hoc payment of $600 million just to keep the farmers going. And they said, and we're liable to require a second payment of $600 million. Well, the minister took that to the cabinet, and the cabinet said, well, wait a minute. How are we going to pay $600 million when these people have two, at the point, if I recall, the number was in excess of $2 billion on the balance sheet in NISA? How on earth are we going to do that? So look, if you think these payments are going to be made, then you got to sunset NISA and get that money out of there, because there's no way we can do that. And he kind of created this little bit of a paralysis, which was kind of an odd situation. I think when we moved to the fixed, the fixed 5-year periods of funding windows, that cleared up a lot of those challenges. How
was NISA wound down in terms of that transition to the APF and the new programs?
Well, the short answer is you had to take your money out. There was a fixed period of time for it. Were you involved with this, Steve? Maybe you're more
it was wound down in 2002. And there was a period of time during which producers needed to take out their money. This kind of started the discussion of the linkage, if you will, between the NISA and the whole farm margin-based programming, and what was NISA meant to cover versus what was the margin-based program meant to cover, which was presumably for deeper losses.
Steve, I jumped to AgriStability before. I guess there was CASE in between, the Canadian Agricultural Income Stabilization Program, which later became AgriStability, from what I recall. Do you remember that transition and what that involved for producers? Yeah.
So to describe the transition a little better, I think I'll go right back to the Farm Income Stabilization Program, Farm Income Disaster Program, which was a 2-year pilot project in Alberta. And then after that, it was called ADA, then CFIP, then CASE, and then AgriStability. So this happened over a number of years. And during this time, they're struggling with the issue of, well, how do we position this program? And you can see this in the naming, right? It starts out as a stabilization program, which quickly changed to a disaster program. They didn't want to give people the wrong impression that this was meant to cover shallow losses. It was a 30% margin drop at the time. Then, ADA came in, Agricultural Income Disaster Assistance. So, the same kind of naming. CFIP was the Canadian Farm Income Program. But then, interestingly, the case changes back to that Canadian Agricultural Income Stabilization kind of identifier. Then, of course, AgriStability has the word stability in it. And I think that has really, over the years of AgriStability, created an expectation gap with producers who maybe think that this should cover for very small drops in income, when really it is a disaster program. It's billed as a disaster program.
Grace, do you have thoughts on this terminology and kind of the evolution maybe from, well, I guess stability is still in AgriStability, but we now call them business risk management programs, not safety nets or income stabilization. Is this terminology significant? And do you agree that there is a gap or at least some confusion in terms of what these programs are intended to do?
Well, I don't work closely with these programs, right? But I thought that the Agri-Recovery Program was more the disaster relief program than the Agri-Stability Program.
Today it is, yeah.
Yeah. Is there any significance in the naming of them? Possibly. I'll leave. That's not I would just, I don't know. I honestly don't know. I mean, it's probably something that people agree on, and I'll leave it to others to weigh in on that.
Well, Kelvin, I'll just comment here on the trigger point, because the trigger point, I think, has been a real point of contention. And in the first three programs that I mentioned, I call Farm Income Stabilization, Farm Income Disaster, I call that one program, followed by ADA, CFIP. All of those had a 30% margin drop factored into them. Then it moved to the Canadian Agricultural Income Stabilization Program, which had 100%. So it triggered at the first dollar of loss. Hence I think maybe the word stabilization was relevant for that one. AgriStability started with an 85% trigger point, so you only had to have a 15% drop. But then it changed to 70%. And had other things in there like reference margin limiting, which, effectively made that trigger point more than 70% for a lot of farms. So I just find it interesting that it's kept the name with the stability in there throughout that time period during which the trigger point went down. However, the trigger point only went down to what it started out as back in 1995. And, went through right until the early to mid 2000s at that level, at 70%.
Yeah, those are excellent points, Steve. Al, do you have thoughts on the stated versus actual goals or outcomes of these programs? Or is this all just about politics and gaining votes?
Well, as far as the naming, that it could be the communications department working overtime. I think that the targets, at least for the core, what we're calling today the BRM programs, AgriStability, AgriInsure or crop insurance, AgriInvest, AgriRecovery, et cetera. I don't think that the lens of those have changed that much, although we are doing other things in policy programming, and maybe we'll talk about that later. But I do want to pick up Steve's point about these triggers. And yeah, if you go back to the CASE program, there was actually 3 tiers of trigger, and back to the earlier discussion that when we had an understanding of how international trade policy was going to define agricultural support, then we could go about designing these programs with greater certainty. Because, it's hard to understate the shadow that was cast by the hog countervail cases. And, it's one thing if you happen to be in the swine sector, but all the other sectors saw it too. The cattle industry in particular in the West was very concerned with that precedent. and they didn't want to get themselves involved in anything that was going to result in that that pain and suffering occurring to them. So when those triggers were designed, they are very, and all the limitations and parameters around it, none of this was by accident. This was basically going to the WTO, the Agreement on Agriculture, and saying, okay, what is a subsidy? What are we going to be, what are we going to be allowed to pay out without particular risk of having a trade case brought against us? Now, I should add that when you're talking about trade cases, in my understanding of it, there's little assured. There's maybe degrees of assurance, but I remember a producer that was involved in a number of farm organizations swearing to me that NISA was not countervailable. But as I mentioned before, the cattle industry had great concerns about NISA. They didn't even want to participate in the thing for fear of that. So, and all we know is that NISA never was challenged. But in any event, just making the point that domestic program design has very much taken its cue from what we can, from what international agreements, notably the Agreement on Agriculture and some of the other agreements under the WTO, tell us are the international rules, and then we can proceed given those.
I think we're going to get to more of that type of discussion, how international trade and international factors could affect or shape how programs look in the future. But Al, I do want to ask, are you saying that these programs weren't necessarily actuarially designed in terms of risk management from a funding perspective from the government side of things?
No, I'm sure that was a consideration, but the first thing, so go back to Steve's observations around 70%. Well, what is special about 70%? Well, if you go to Annex 2, I believe it is, of the WTO Agreement on Agriculture, you will find that there's a definition of a green program. So green programs don't count against what's called your aggregate measure of support that countries have to notify. That's the so-called amber subsidy. So that's why we designed them in this way. So there's nothing magic about 70% other than it maps back to some of those parameters. For a period of time, and Grace will recall this, that after the WTO agreement, we had something that was called the peace clause. And the peace clause was sort of an informal agreement among countries that they wouldn't take trade cases against one another on payments that were green under the Agreement on Agriculture. Now that's long ago. The peace clause is long ago expired, and to the best of my knowledge, countries, I have to think of a case. I don't think any country has challenged another on the basis of its green program payments. But these were all the considerations that went in, and it was taken very seriously, particularly by Canada, and I would say largely after the experience of the hog counter bill.
Okay. Steve, going back to what we're hearing about the history of the 80s and 90s and the evolution, some of the major changes that happened in terms of these support programs for farmers. Looking back at the last 5 years, I know you've been heavily involved or closely following the evolution of the BRM over the last 5-10 years, that time frame. Can you imagine making such substantial change given how difficult it has been to just make tweaks to the programs in recent years?
Yeah, it has been a real challenge because, as you say, the last 5 years have been pretty intense. There's been almost nonstop consultations on AgriStability and BRM. And really what we have to show for it is we have the reference margin limiting feature removed from the program and changes to private insurance where producers can buy private insurance and benefit from that. And then the AgriStability coverage effectively stacks on top of that. We also have an increased compensation rate. So they haven't changed the trigger point, it's the compensation rate. So once the producer starts getting some funding, instead of 70 cents on the dollar, it's now 80 cents on the dollar. So those are kind of the changes that have come out of the last 5 years. My take on it is that the AgriStability program and all the predecessor programs, but more so AgriStability in case than the others, are pretty effective programs that are based off of an accrued income statement. They protect a good chunk of that accrued income statement called the margin. So they're protecting the revenue, which is price and production. They're also protecting certain costs, but not all the costs on that income statement.
So in your opinion, AgriStability is an effective program. I know farm groups are always asking for more predictable, quicker response. Those are some of the things that they're looking for. Do you think that's feasible, Steve, with what we have?
Yeah, I guess what I was going to say earlier there about AgriStability protecting a good chunk of that income statement. So it is tailored very specifically to the individual farm, right? So it is based on the actual farm's data and comparing that, a 5-year history to the current year, of course. That's what makes it a great program. It is based on the actual farm. But yeah, over the last 5 years, there have been definitely some calls for simplicity and timeliness. Those are the two things that come up the most often. And, of course, they're trying to do that. But the problem with this, and, I think that same problem kind of manifested itself kind of early on in these programs too, was back with, I believe it was the CASE program. So prior to CASE, and even during some of the early years of CASE, these programs had a number of forms that were either required or they became optional, where the producer could go through or the accountant could go through and figure out what the estimated payment was. And back then, even, there were calls for simplicity. And so the answer to that simplicity was to change the interface. So to remove those forms so that the producer or the accountant, whoever was preparing it, was no longer calculating that payment. And they were just filling in a minimum of information and sending it into the government. At that time, when they switched that model, we as a firm made the decision to continue calculating the payments. So we designed software to help us calculate payments because, we know that human beings are fallible, and we're going to make mistakes, right? Accountants make mistakes. Producers sometimes make mistakes, and the administration will make mistakes. So as we have continued to calculate those payments over the years, we always have a frame of reference. So when the assessment comes back, we can compare and note, why are there differences? Did we make a mistake? Did the producer give us the wrong information, or did the administration make a mistake? And we're constantly having to go back and get things changed. So, now fast forward to AgriStability, where you had asked about the simplicity and timeliness. I think in order to get further simplicity, it doesn't necessarily simplify things behind the curtain, so to speak. So if the government wants to make the program simpler for the producer, I believe it's actually going to get much more complex behind the curtain, or with what the government is doing with the information. And it's going to get more opaque to the producer. And I'm not sure that that's something that is going to be good for these programs long term. Timeliness, yes. I mean, that's consistently been an issue that producers are frustrated that they have a bad year. They apply for the AgriStability the following year, and then there is often a time lag, which can be significant depending on the province. So looking at ways to make it more timely, it definitely should be an objective.
Steve alluded to the the consultations that have seemingly been ongoing the last number of years, and it looks like that's going to continue with the new framework as they're planning to consult and continue to review and look at how it could be changed, how it could be improved. I guess that depends on perspective. Al, what do you see as we maybe shift our focus more towards what these programs look going forward? What do you see the next steps being in terms of the evolution of business risk management programs, including AgriStability being the focal point of what we've been talking about here?
Sure. Let me start by building off what Steve was saying. I think Steve was saying that simplifying programs can be pretty darn complex.
Yeah.
And I agree with that. I think we need to remind ourselves, just pausing on AgriStability for a moment, largely driven, I believe, by budget issues federally. Let me see now, would that be the 2013 edition?
When there were cuts or when there were changes?
Yes, we lost it. Yeah, we lost a tier of coverage in AgriStability, and that reference margin limiting feature was brought in, and I think that pick up a couple of things that Steve said. The fact that it's individualized, it's tied in with the income tax system. It has a form of accrual to it. I think these are all very strong positives for AgriStability, and it's I kind of feel bad when you hear a lot of the criticism of the program for those reasons. Now at the same time, we lost that tier of coverage, and for producers that have a lower proportion of their total costs as allowable under the program, which essentially means cash. So if you think, if you have a high proportion of costs that are effectively depreciation on equipment, for example, it's not going to be as sensitive for you. And there's dissatisfaction that's grown out of that. And it's understandable. I don't think it makes AgriStability a bad program in any way. I just think it makes it less sensitive, and that's sort of how it's evolved. We've taken out the reference margin limiting. I think there are some who are still looking for more sensitivity, and there's some good reasons. And there's some good reasons for that. Looking forward, as you asked, Kelvin, I guess there's two things. There's been more and more interest as we've had the 5-year agreements in having, the bulk of the budget still taken up by business risk management. But there's been more and more interest in funding, I would say, environmental programming in particular, some forms of extension to maybe pick up some of the gaps in provincial funding. Depends a little bit where you live, but provincial funding of extension services, some research that's I would say on the environmental side, there's been a real interest, and that's probably a whole other topic unto itself. But that sleeve of funding has come into it. The other thing that I think, I don't know how you describe the world since about 2018, but particularly maybe in the last 18 months or so, but we seem to have gone from the worry of there being abundance of farm products and low prices and unstable farm incomes to much more of a scarcity situation. And you could think of it any number of ways, like fertilizer is scarce and expensive, seed is scarce and expensive. We've had warfare, we've had geopolitical tensions that have really compromised in some ways. We've been talking about the WTO agreements in the mid 1990s and the world that existed then, and that world persisted, for quite a long period of time. But that world seems to be changing now, and what I worry about now is, there's always going to be worries about instability in farm incomes, and we shouldn't lose that. But now, it's just the instability in costs and levels of costs. It seems to me that a lot of the risk is actually turning over to finance rather than so much on the income side. And that creates a demand to me for a different set of programming. Now, I would like to flag the advanced payments program, and hopefully a lot of your listeners, Kelvin, are aware of the program and make use of it. It's essentially it's working capital that you can borrow against crop insurance guarantee. Because you go from year to year. You can go back and people can reflect on their own experience. What their fertilizer costs were, let's say, in the spring of 2022 versus 2021, or versus 2020, and this is dramatically different. And for many people, that's a cost they have to carry through to harvest. Well, those operating lines will have been stretched for some people, at least I would imagine, very badly, and probably a heck of a lot of personal, if not financial, stress along the way. That may be some of the new demand for programming that we have, is to deal with that financial side of it.
Is there an aspect of private market providing solutions for that risk management? I'm not sure, Al or Steve, maybe you want to comment on that?
Well, let me just start, and then I turn it over to Steve, who would see this more firsthand. A lot of people say, well, look, I got a relationship with a commercial bank or FCC. I mean, they'll provide, well, not sure if FCC provides working capital necessarily, but commercial banks certainly do. So no, they got working capital. Yeah, but boy, I don't know, what Steve has seen in the last year with M&P clients, but I when I talk to farmers, it's kind of like, well, geez, I had to go back and renegotiate my credit line 5 times just to keep my hedge positions on, if I've got grain or livestock hedge, as the case may be, let alone what I need to be able to float my boat to keep on going through this escalating cost of farm inputs. So I don't know, how prepared or how expensive that type of financing is going to be through commercial banks.
Steve?
So yeah, when the finance risk increases, it's going to have an impact on the income statement, and we've been looking at that for our clients. I think it makes it even more critical to make sure that you have your income statement insured. AgriStability and other programs might not cover anything to do with finance, but they cover large portions of the income statement. And the best way to make sure you have your finance risk under control is to make sure that you have a stable source of income that you can rely on and is bulletproof. So it's insured. We also have to look at the impact on their debt service level, which is a different calculation. And so it's not just about looking at the income statement. They might need to be able to fund more than their expenses on their income statement. Their debt service level might go beyond that. But definitely in order to ensure they have a strong balance sheet over time, you need a strong income stream feeding into that, and ensuring that income stream is of utmost importance.
I do wonder, from the government's perspective, and the cuts to the AgriStability program in the early 2010s were alluded to earlier. I do wonder, and we've seen provincial ag ministers favor a shift towards more of an insurance, possibly a private insurance type model in some of the negotiations over the last number of years. I do wonder, you add also increasing crop insurance premiums that governments are covering with rising crop values. I do wonder about the fiscal constraints on the government side of things going forward. Al alluded to the environmental components that have also been discussed or even implemented in the case of AgriInvest under the new ag policy framework under the Sustainable Canadian Agriculture Partnership. Grace, your thoughts in terms of where you see some of these BRM programs headed and what some of the priorities are for government?
Well, I don't know the details around the business risk management program the way that Steve and Al do, so I'm not going to comment on those. But something that probably would never go down in Canada is what the European Union has done with its common agricultural policy. It's made direct payments contingent upon farmers meeting the environmental standards practices that they've brought in, that sort of cross-compliance. I don't actually see this happening too much in Canada, but that would be one way to go. But I do agree entirely with Al that that the environmental issues and the climate change issues are not going to go away. And again, this is a good example of the convergence of domestic and international pressures here. We have a prime minister who, I guess alone of the first prime minister in a long, long time who actually is trying to meet the commitments that Canada signed on to. At the Paris conference, we've had previous prime ministers who signed on and then never could realize those commitments when it comes to reducing greenhouse gas emissions. So we have, this international commitment, which is putting pressure on domestic governments, and that is going to be sustained because we obviously have in this country as well, certain mobilization on the part of environmental groups, and I think farmers also want to do something about this because climate change is a risk for them, right? And so I think this is going to continue to be a big source of a big issue. And I don't really know for sure how the programs could be reconfigured to take it into account. So far, what I would describe as going on is what I would call sort of layering of policy. We're getting a separate suite of programs that are meant to deal with the environment, meant to deal with sustainable agriculture and climate change. Those are just kind of being added on to the business risk management programs, as I understand it. So this will be a very slow process probably to get really effective action here. But, it's not surprising that it takes a while here and that change moves slowly because you've got 10 governments that have got to agree, 10 provinces plus the government of Canada. And then you've got a very mobilized agri-food sector that has quite a lot of support in not just on the part of the provinces, but also in the House of Commons. And so, it's always going to be a slow process, an evolutionary process when it comes to changes here. And so I think what the federal government is doing, and probably some provinces are saying, okay, so we'll just bring in an ancillary suite of programs here. That's the best way we can proceed.
Grace, I just want to hear your thoughts on part of what you said there in terms of having all the different levels of government come to an agreement. We have seen Ontario, for example, roll out this risk management program, a provincial program. In the long run, do you see the FPT arrangement holding, or do you see there being, and Quebec, of course, has had their own programs all along in some ways, do you see an ebb and flow or the pendulum maybe going back the other way in terms of the strength of the FPT arrangement?
These arrangements have now, we had since 2013, like we're coming up on 20 years of these programs, these 3-year, 5-year programs now being in place. It's working. I think we can find that if we think about the difference between agriculture and healthcare, for example, the conflict in this sector is I would regard considerably less. I think that the federal government is taking important steps, I think, to make sure that it's consulting with producers, not just the provincial and territorial governments, but I've been impressed with the amount of consultation that's going on around the Sustainable Canadian Agriculture Partnership. And so I think, the process, it seems to me, I'm not going to say the process is locked in, but it seems to me it's a process that is proving effective in kind of moving change along slowly and incrementally. It's probably too incrementally for many people, but I don't see any other process short of a government sort of unilaterally deciding it's going to go its own way. This happening. Alberta could easily opt out. The fact that Quebec is kind of, it reconfigures things slightly. It's important that Quebec deliver programs for its own sort of, province building goals. But I think it's about as robust a policy process as you can find in any sector of federal-provincial relations.
Interesting perspective. Al, your thoughts on the integration of these climate and environmental related goals? It looks like the province is pushed back on what the federal government wanted to implement in this new partnership in terms of cross-compliance. Does it work to integrate cross-compliance and some of these environmental policies or priorities into business risk management programs, or do you see there having to be separate programs with separate stated goals and intents to successfully achieve both of these goals at the same time?
Well, I think the fundamental problem that you run into when you get into that is, we have demand-driven programs, which means another way to say it is you have to lose money before you get money. So, the idea that you're going to somehow, you're going to have to cross-comply in order to lose money to get money, I think this is probably not going to work. I'm trying to imagine, somebody who's, flood, tornado, drought, they've lost everything, and somebody's going to say, well, we'd be happy to help you from government programming, except, you didn't have an environmental farm plan, or you didn't adopt this, or you didn't adopt that. That, I don't think that particularly washes. So no, I think the way around that, or the way to better address it, maybe, is to say, well, no, we're gonna fund some environmental programming separate from the business risk management programs, and we're going to proceed with it that way. The difficulty is real quickly, because I think this is probably a whole other discussion. Going back prior to the agreement on the next the SCAP, the forthcoming, or I guess current now, 5-year agreement. There's a big sort of sustainable ag portion that the federal government was saying that they were more or less going forward on this themselves. The difficulty is, because you've got so much of your resources that are extension related, or field offices out close to be able to support producers that are at the provincial level. If you try and launch something uniquely at the federal level, it's just hard to make progress with it, and I think that's the challenge that we have going forward. Steve,
how do you? I might give you the final word here. How do you see this from your client's perspective? And I know earlier you talked about the complexity or the simplicity of these programs, and how I guess financial literacy is something that we haven't talked about here yet. But in terms of what we expect as farmers, what we're expected to understand, and the level of financial literacy required to understand these programs, if we move towards integrating some of these other cross-compliance requirements or criteria into business risk management programs, how would that affect your clients from your perspective?
Yeah, I agree that financial literacy is one of the keys here. And I know for the next framework, we've already talked about the fact that there's been 5 years of nonstop consultation. And, there have been some good, positive things that have come out of that, but not necessarily increased program participation. So, Al brought up that point that if you start marrying these climate objectives with the programs, that is not going to help the program participation going forward. This constant call to simplify these programs, I think, actually goes counter to financial literacy. It's almost like producers are thinking that, well, if we change the program enough, it will become a great program. We'll understand it just intuitively, and it'll compensate us when we feel that that something has happened on the farm that deserves compensation. And that's really not the way that things work. These programs are accrual based, AgriStability in particular, and they're meant to protect the income statement. So I think it's important for the producers to understand their income statement, their accrued income statement. And that is one of the problems, is that there's a lot of producers that still don't have an accrued income statement. To make the statement that, well, I want to protect my cash basis income statement, that's a nonsensical statement. Accrual is different than cash. It's actually measuring the actual performance of the farm, and that's what you want to protect, in real time, so that There is a steady stream of income flowing back to the balance sheet, growing that balance sheet and providing for future generations. So I think it's important for producers to invest something in financial literacy. And I can tell you that every time somebody does, they understand not only their own business better, but they will understand these programs and how these programs work together to ensure their income statement. The other issue is that I think governments are still trying to come up with how are the programs going to change. We already know that for 2023 and 2024, the first 2 years of this new framework, the Sustainable Canadian Ag Partnership, it's likely going to be AgriStability as is. So, I would think definitely for this new framework, there isn't any room for marrying the climate objectives with the business risk management programming. And I confirmed that those objectives are going to be very, very difficult to achieve at the same time through the same program. We've talked a bit about how governments need to agree on some of these objectives, but I think it's also the farmers and the people as well. So there's a lot in a name. We've looked at the names of some of these programs over the years, but look at the names of the framework. So the one before this was called the Canadian Ag Partnership, and now this is called the Sustainable Canadian Ag Partnership. The name alone is kind of implying that, well, it wasn't sustainable before, but it is going to be sustainable now. And, that's an implication. I've also heard people saying directly, well, we are going to make this sustainable, the government. So, I guess if I was a farmer or, a citizen, I'd be wondering, well, what made farming unsustainable after millennia? It would be important to, have that discussion before getting into, marrying programs together, or, even having separate programs for that objective.
Yeah. There is one area that I was hoping to cover. And so, Grace, I'll maybe quickly ask you to comment on, we've alluded to the WTO and the importance of GATT, and to bring this conversation full circle, going back to the early days of farm programs in the 80s and 90s. We have seen a shift globally away from multilateral rules-based trade. How does that affect what governments are dealing with in terms of risk management at home?
Yeah, well, it's certainly, it's starting to look as though that WTO era was just an interlude. But the WTO, Committee on Agriculture, has made some progress. I mean, it did get an agreement to outlaw, as I remember, export subsidies. It is also, I think, doing something on food security. There are discussions going forward. But the important point is that we really can't count on the WTO rules or the Agreement on Agriculture to be upheld as long as you don't have a dispute settlement mechanism there. And the USA walking away from naming members to the dispute settlement mechanism has been a major blow. And you get back into a situation where access to agricultural markets is sort of dictated by the willingness of the country that you're trying to ship into to agree, to let your product enter. So it is a different situation, a very different, I think, international context. I agree entirely with what Al was saying earlier about the sort of the heightened risk now. What led to this suite of programs that we've been talking about was the uncertainty, the risk that was there around markets, but also in terms of other countries' policies. And now we seem to be back into another era where the uncertainty around other countries' policies, not just their agricultural policies, but their geopolitical ambitions as well, are really intruding again into agricultural markets. And it is a very different context, and how that gets written into Canadian agricultural policy is still, I think it's a challenge, and I don't know how this is going to end up.
Yeah, there's always that competitive issue. I think we've crammed a whole lot of different aspects and excellent thoughts and insights into this discussion. We could definitely do a whole series on business risk management programs and all the different things that we've talked about today. I think we could have several spin-off episodes here, but I want to thank Al, Steve, and Grace, the three of you, for taking the time to discuss these and share your thoughts on business risk management as it stands in Canada and what it might look like in the future for farmers across the country. Thank you for your time today.
Okay, thank you. It was a pleasure.
Thanks for having me.
Again, there are certainly a few more angles or perspectives that we could have gotten into when it comes to risk management, and maybe we will down the road. Crops versus livestock, the differences there would be one example. Also how each province handles business risk management programs differently when you look at Ontario and Quebec specifically. But I think we covered a lot of ground there with Al, Steve, and Grace, and I want to thank them again for their time. In many ways, this discussion built on what we talked about in episode 1 of the Ag Policy Connection, the history of the ag policy framework under which all of these programs exist. So if you haven't listened to that episode with Douglas Headley and Scott Ross, or if you missed any of our other Ag Policy Connection episodes, you can find them on Real Agriculture, on Spotify, Apple Music, wherever you listen to podcasts. We are going to keep things rolling, trying to release a new ag policy focused themed episode every week. Thanks again to the Canadian Agri-Food Policy Institute for partnering with us on this project. And most of all, thank you for joining us as we try to connect the dots and explore the big policy issues in agriculture right here on the Ag Policy Connection.